How is the California Premium Assistance Subsidy calculated? Well, as they say in social media, it's complicated. Hi, I'm Kevin Knaus with InsureMeKevin.com, and today I'm going to present a kind of a high-level overview of the calculations for the California Premium Assistance Subsidy using the Form 3895 and the Franchise Tax Board 3849 to kind of give you a feel for what's going into the calculations, how it differs a little bit from the federal calculations for the subsidy, how the two are intertwined, and how sometimes one cancels out the other. So here is kind of a brief overview. It does get a little bit complicated, I apologize, but you have to get into these worksheets and you have to get into the numbers if you want to try and understand it, so you can maybe find out what's going on with your tax return and why you owe so much back to California, or why the subsidy is so much higher. The start point and the end point for the federal and California health insurance subsidies all begin and end with the same set of calculations. First, the modified adjusted gross income is divided by the federal poverty level for the household size and region of the family. That yields a FPL percentage, which corresponds to an applicable figure, also known as a consumer responsibility percentage or fair share. The applicable figure is then multiplied by the modified adjusted gross income to equal a consumer responsibility dollar amount. The second lowest cost silver plan in the consumer's region minus the consumer responsibility equals the premium tax credit. In this particular scenario, Joe and Cam estimated their modified adjusted gross income at $55,000. There is just two people in the household and no dependents. They took the $55,000 and the Covered California Business Rules engine applied the federal poverty level for a household of two in the region, which is $16,910, which turns into a percentage of 325%. The California subsidies are there to make health insurance just a little bit more affordable for certain households between the income ranges of 200% and 400%. And the federal subsidies end at 400% of the federal poverty level, and that's when the California subsidies really kick in up to 600% of the federal poverty level. There are no California subsidies between 138 and 200% of the federal poverty level. Within the instructions for Form 3849, where consumers reconcile any premium tax credit they receive from California, there's a series of if-then statements. If your income is in a certain range, then you either get to take the credit or you don't. In this case, the income falls between 200 and 600% of the federal poverty level. That applies to the California applicable figure table, and you can come down and see at 325%, the applicable figure is 0.09095. That applicable figure is then put on line 7 and multiplied times the modified adjusted gross income to yield a consumer responsibility of $5,002 or $417 per month. To verify that the calculations are correct, I went to the Covered California Shop and Compare tool for 2020, put in 2 adults, household size, ages 55, and with a particular zip code, and the second lowest cost silver plan after the subsidies have been applied was $416.94, very close to the $417 that the formula predicted. Now, the subsidy of $1,790.90 is a combination of a federal subsidy of $1,759.59 and an additional California Premium Assistance Subsidy of $31.31 per month. Consumers at the end of the year will get a $38.95 with a variety of information and data that they need to use to reconcile their premium tax credits. Column A in Part 2 of $38.95 gives the enrollment premiums for the health plan that the individual or family chose. Column B is the second lowest cost silver plan. The second lowest cost silver plan is the benchmark plan, and that is the target for determining the subsidies because the whole point of the Affordable Care Act is to make health insurance affordable, and they have targeted the second lowest cost silver plan. Column C is the monthly subsidy California paid to the health plan on the consumer's behalf for their ages and estimated modified adjusted gross income. But of course, life doesn't always work out like we think. Joe and Cam originally estimated their income at $55,000, but their final modified adjusted gross income, which was calculated on their federal return, came out to be $65,000. So $65,000 divided by the federal poverty level yields a higher percentage of 384%. The applicable figure from the California table was 0.09555, yielding an annual contribution consumer responsibility of $6,211 or $518 per month. That information and some of the other calculations are brought down into Part 2 of Form 3849. Column A, 11A, is the annual enrollment premiums. Column B is that second lowest cost silver plan. Column C is the annual contribution amount determined from the lines above in Part 1. And then Column D is the annual premium tax credit amount. Now, this is essentially the same calculation that happens on the federal taxes, where there is also an applicable figure, and the system just goes through and recalculates what the federal subsidy should have been, and the final number should mirror the reconciliation on Form 8962 for the taxpayer. It's just easier to keep this number within the system as opposed to requesting people take a number from their federal taxes or a different form and bring it over. So that number is brought in as $20,137, and then column E is just a subtraction of the different amounts to determine what the California subsidy should be. So they're just subtracting C and D from the second lowest cost silver plan, and that comes up to $146. Column F is then used to determine if they were eligible for a subsidy, because there can be some cases where the federal subsidy is large enough and pays for all of the that they should be getting within the applicable figure. And so oftentimes worksheet number 5 will just confirm what has already been calculated. Column G is what California paid out on their behalf. So line 24 is $146 of what the couple was entitled to at the higher modified adjusted gross income of $65,000. And then you subtract that from what was paid on their behalf, and there is a difference of $229.72, which must be repaid to California on the California Income Tax Return Form 540. Now, just like the federal, there is a repayment limitation. So if that number that needs to be repaid is too large, the repayment can be limited in some instances. But if the income is over 700%, all of the premium tax credits must be repaid. Well, hopefully that answered some of your basic questions. In follow-up videos, I will be looking at how the California Premium Assistance Subsidy may change and how that might impact the federal tax return if you are self-employed. Sometimes people must repay all of the California Premium Assistance Subsidy if their income drops or if it goes too high, and what that means for getting a larger federal subsidy and vice versa. So it all gets a little bit complicated, and all I'm trying to do is provide you some groundwork for understanding how the whole system works so you can troubleshoot things on your federal and California income tax return. So for InsureMeKevin.com, I'm Kevin Canals.